Hello everyone, welcome to Just Invest today. And today we have a good video for you guys. We're going to be talking about Alibaba. We want to find out if this stock is undervalued in the market right now. Let's see what the intrinsic value of Alibaba is, and let's see if we can find a price and what we think the price of the stock's going to be in maybe 5 years, in 10 years, or in 20 years. And let's see how much return we can get on our investment today. Before we find the intrinsic value of Alibaba, we got to make sure that can we understand the business? Does this business have a competitive advantage? How is the management allocating capital in the business? Is it doing it efficiently? Is it capable of doing it? And then we're going to find the price. But before that, we have to fill out all those boxes, making sure we got all that stuff down, and then we can try to predict the future and see if we have an undervalued company. Alibaba is an e-commerce online retailer giant. Basically, you gotta think of it as like Amazon mixed with eBay. It has so much things. It has consumer to consumer called Taobao. It has business to consumer Tmall, and it has business to business sale services Alibaba, and it actually has AliExpress. It's like an online retailer. Chinese businesses selling products internationally to online buyers. Also contains online payment services, shopping engines, and cloud computing. So when you think of Alibaba, kind of like Amazon, like an online retailer, when you think of it like eBay, consumer to consumer transactions, it's very fairly easy to understand the business and kind of see what it does. So I feel like we have that concept of what Alibaba does. But now we got to look at the breakdown of its revenues and see how much is it getting from the e-commerce section, the digital marketing, fintech, cloud computing. So 65% of its revenue is coming from the e-commerce section, 7% from the digital media, Chinese wholesale 12%, international commerce revenues 8%, and cloud computing 8%. So this is a very diverse business. The fact that Alibaba's revenues are so diverse, this is actually very positive news because it doesn't really rely on one sector, even though 65% is relied on one e-commerce. But over time, the other sections are going to get bigger and bigger. So we can depend on Alibaba finding ways to make revenue to generate profit in the future. And that's, I think, a very key aspect of Alibaba's business. China is set to become the largest retail market in the world in 2020, overtaking the US. It is a highly developed e-commerce market with an online accounting for around a quarter of all retail. China represents the largest market for e-commerce in the world and is bigger than the next 10 countries combined at 1.5 trillion, and it's growing at a 24% compounded annual growth rate and 25%. The e-commerce market for China is going to be huge in the future. There's so much potential, and you should really look into Alibaba. When we think about the economic moat for Alibaba, we have to go to this article because when we see that 44% of the global e-commerce market is owned by 4 Chinese companies in the world. Look at Alibaba, 14% in Tmall and 15% in Taobao, and that's 29% of the world's e-commerce market. And like that, compare that to Amazon, and we know how big Amazon is, and it's only 13%. JD.com is 9%. So 58% of the global e-commerce is contributed in just 6 companies. The economic moat for Alibaba is crazy because they have such a huge network. It's connecting merchants to customers, and that's such a healthy network. It's so hard to penetrate and it has high barriers to entry. You need around $187 billion of assets just to compete with Alibaba. What I really love about Alibaba's management is they have a lot of smaller companies in Alibaba, and they acquire so many companies. When we look at Alibaba Pictures, South China Morning Post, an English language newspaper. And when it does this, it's looking at these companies to be able to prosper inside the company and generate a profit for this company in the future. Look at this, it has an e-commerce platform in Singapore. Like, this is going to be worth a lot in the future, and this is what Alibaba's management does. It keeps finding these companies, gets these stakes, and then makes them bigger. Look at this, in department store, an in-time department store. And all these acquisitions are going to generate future cash flow for the company. When it comes to the valuation now, we want to see the revenue growth, we want to see the free cash flow growth, and the book value growth of Alibaba so we can come to a conclusion on what the future growth rate of this business can be. And when we look in the last 5 years of Alibaba, it's been growing at 44%. Crazy. Free cash flow growth, 28%. It's amazing. Book value growth, 32%. And in the last 12 months, 25%. Free cash flow growth, 18%. Book value growth, 41%. So when we look at these growth rates, we can kind of get a ballpark of an estimate, and we want to be conservative on our estimates of the future growth rate of Alibaba. So this is my margin of safety analysis of Alibaba. So we're starting at an earnings per share of 7.9, and that's how you come up with Yahoo, not Yahoo Finance, but when you go on Microtrends, and 7.9 is what it earned on the shares outstanding of the company, the net income, and what it earned on the shares outstanding. So it was 7.9. And when I think about windage growth rate, I'm assuming that Alibaba will grow 20% yearly. And I think that's a fairly good estimation, a pretty conservative of what we've been seeing of just on the other slide of how fairly Alibaba is going to grow into the future. And I think 20% is pretty conservative. So at 20%, we're going to sell it at a 40 PE in the future. And our minimum amount of return we want on this company is 15%. So for evaluation, we get a 483 fair value today and a margin of safety of $241. So we're gonna sell this company at a future valuation in 10 years at $1,900, and we can pay a fair price of $483 if we're gonna assume that it's gonna grow 20% into the future. So that is pretty good because Alibaba right now is selling around 260 $250. But the thing is, with Alibaba, we don't need to pay a margin of safety price because the company is so good. So paying $483 today would be a good price, and it's only selling at 250 $260. So let's put a conservative estimate. Maybe Alibaba only grows 15% a year, and then we sell at a future PE of $30. The fair price today is still $237, guys. We can see that Alibaba is still pretty fairly priced, and that means that we should buy this company because there's so much future growth ahead of it. So when we look at Alibaba, we can see that Alibaba is very undervalued right now, but that's because it comes with huge risk. The government wants to stop monopolies in China, and it actually fined Alibaba because it didn't go to the Chinese government when it wanted to acquire a company or acquire shares of a company. So when we look at these practices that the Chinese government is doing, it kind of wants to stop these huge companies from coming too big and too powerful because remember, the government is a communist government and it want to kind of lay the hammer on these companies so they don't try to overcome him or try to overpower him. So he wants to have that like kind of feeling of importance and he doesn't want like companies to overshine him. So it also stopped Ant Group's IPO. So that's another reason. It's stopping IPOs. The government is finding these monopoly companies and it's really hammering down on these big monopoly companies. So if you believe that this risk is huge, I don't know if you should invest into this company and then America delist these Chinese companies from the stock market, which if they delist Alibaba, that's going to send the shares flying down. So we have to look at all of these risks and then come to our own conclusion on what you think Alibaba is going to do in the future. But for me personally, I have a huge stake in Alibaba. I believe the future of the e-commerce growth in the Chinese market and Alibaba's just revenue has been growing at 25% a year. Free cash flow growth been growing crazy, 18% a year. Equity growth 34% yearly. Like Those numbers you do not see in the average day company. It's so dominant, it has a moat. So I really believe in this company. So I want to know what you guys think about this company. Do you believe in it? Do you think Alibaba's going to grow in the future? So what do you guys think about this company? Does this company have high potential, or is it just too much risk for you guys? Tell me what you guys think. If you like this video, subscribe to my channel, and I'll get back to you in the next video. Peace.